The coronavirus pandemic has caused unforeseeable economic conditions and changes in consumer demand, which numerous companies have responded to by writing down substantially more assets, hence reducing their value. These companies are taking big baths, a one time charge against income to reduce assets, resulting in lower expenses in the future, so as to appeal to investors and creditors. This was the case with Boeing in 1997, where managers received bigger bonuses due to altering the financial statements to depict a poor performance one year and a highly improved performance the next. However, big baths don't always result in significant losses, as was evident with the National Australia Bank's Big Bath in 2005. Big baths can also allow losses to be settled all at one time, as Samsung Electronics did in 2008. There are advantages in allowing managers the flexibility to charge one-time impairments on assets, namely that the depreciation expense for further periods will decrease, allowing for more profit gain in the future, and the loss on impairment will decrease the future income tax expense. However, there are also advantages of depreciating or amortizing assets to a prescribed schedule, such as it being less volatile to the total value of the corporation, reducing the taxable income, and assisting to match the cost of the asset and its revenue in different periods. The advantages of each approach will be evaluated and weighed against the standards outlined in the Australian Accounting Standards Board to determine which is preferable from a regulatory perspective.
Entities use techniques like big baths to manipulate their income and, by extension, their financial statements. This accounting technique has been used in the past and is still used today. While entities may operate within the boundaries of their respective accounting standards when they perform a big bath, it is generally considered an unethical practice. For example, in 1997, Boeing Co. in July and October quarters took charges of $4 billion and $2.6 billion in costs as it could not keep up with record orders. The company was able to estimate future costs of aeroplanes, and if it underestimated these costs, it could carry out write-downs to provide a faithful representation of the actual costs. This, however, supplies Boeing Co. with the ability to manipulate its financial statements to articulate a higher return on equity in following years. In this case, the entity's shareholder equity was decreased by 20%. As a result of this, the company's managers have greater control over the values portrayed in the financial statements. These sizable one-time charges give managers the ability to alter the profitability of a firm in 1 year to depict poorer performance, and then increase the profitability of a firm in another. This often leads to bigger bonuses for managers in the following years. When a big bath is performed, they are not always accompanied by significant losses in profit. For example, from July to March in 2005, National Australia Bank has a profit of $2.5 billion, which has increased by 17% from the previous year. In the notes of the financial statements, NAB recorded the sale of its Irish banks with an after-tax profit of $1.1 billion, along with a multitude of negative provisions. These provisions, hidden in the notes, act as a way of cleaning the balance sheet and the firm. More recently, in 2008, Samsung Electronics reported an operating loss of 437 billion won in its fourth quarter. Another advantage of big bath accounting is that a firm is able to settle all losses at one time. Analysts revealed that Samsung spent significantly more on marketing and management costs in quarter 4 in 2008 than they usually do. The costs totaled 4.4 trillion, which was an increase of 1.15 trillion. This led users of the financial statements to assume that Samsung wrote off certain losses aggressively, hence why a big bath technique was presumed to have been used. The advantages of big baths can be summarized into 3 points. 1. A tool to earn bigger bonuses in the following profitable years. 2. A strategy to settle all losses at once. And 3. A technique to clean balance sheets.
The charge of impairment on assets occurs when the fair value of the assets is less than the carrying amount of the assets. According to Financial Glossary, charge impairments on assets will be recorded in the consolidation worksheet. There are two main advantages of guarantee managers the flexibility to charge impairments on assets. The first main advantage is that when manager charge impairment, the depreciation expense in the future will decrease and the profit will increase in the future. According to ASB 136, paragraph 59 and 61, the impairment charge occurs only when the recoverable amount is less than the book value of the assets. Therefore, the book value of the assets needs to decrease to the recoverable amount of the assets. At the same time, the depreciation expense will be the recoverable value of the assets divided by remaining number of years. Quick example, for 10-year useful life assets, the current depreciation expense is the carrying amount divided by 10. However, after 5 years, when the recoverable amount is less than the carrying amount, so the depreciation expense now is the recoverable amount divided by 5. Therefore, the depreciation expense actually decreased from original to now. Therefore, for the U.S. company who written down so many assets this year, the occurrence of impairment loss will lead to a depreciation expense decrease and more profit in the future. The second main advantage is that when manager charge impairments, the loss of impairments will lead to decrease in the income tax expense in the future. According to ATO, impairment loss belongs to the expense that will decrease the profit and cannot be deductible from assessable income. The example could be accounts receivable plus allowance for doubtful debt equals to the tax base. So in this way, according to the textbook chapter 12 at ASB 112, page 25, the deductible temporary difference occurs when the carry amount less than tax base, which is carry amount plus deductible amount minus the taxable amount equals to tax base. Therefore, the deductible temporary difference will lead to the deferred tax assets. On the other hand, as the impairment loss decreases the profit, the company will pay less income tax. Therefore, the written down of more assets by U.S. company will lead to carry amount less than tax base and decrease in the tax expense in the future.
Let me introduce the advantages of depreciation and amortization. They can be concluded in three aspects. First of all, depreciation is a process of allocation of cost of assets over its useful life. It may have less impact on the carrying amount of total assets of the company in each year compared with one-time impairment, which may have a huge shock to the company. There will be significant volatility of the company's share price in the period of big birth, and the company's composition will be changed. Investors must revalue the company's total assets and change their investment plan. Managers of the company may modify their operating strategy substantially based on the range of influences. Risks of subsequent development of the company arise. However, compared with the one-time impairment, the depreciation method will bring about less volatility to the total value of corporation and maintain its stable growth. Uncertainties will be circumvented and the company will remain steady profits. There will be stable accounting data in the following years, which is especially important for small and medium-sized enterprises. Secondly, depreciation and amortization lead to continuous taxable income within the useful years of assets. When calculating current tax liability, depreciation and amortization expense can seem as tax deduction, which can reduce the taxable income under Australian Accounting Standards Board 112 and improve tax savings in the following operating years of the corporation. Although they have no direct impact on cash flow, depreciation and amortization expense can influence it indirectly by lower cash outflows and reduce the cash pressure of company in the long run. In addition, depreciation can help the company match the cost of using assets and its revenue in different periods. According to the matching principle, revenue generated should be matched with relevant cost in the same accounting period in the income statement. Thus, the depreciation expense, described as incurred cost because of usage of assets, can be matched with revenue that the asset earned in the same period. Otherwise, net profit of the company may be overvalued or undervalued. Accuracy of relevant accounting data will be lost.
We will now evaluate these methods from a regulatory stance. Should firms impair their assets as they please, or should they depreciate or amortize on a prescribed schedule? To do this, we must first look at the relevant accounting standards for impairment, which is found in AASB 136, Impairment of Assets. Firstly, when identifying an asset that may be impaired, AASB 136 requires that assets be screened for indications of impairment before undertaking any testing. Paragraph 12 lists external and internal indications of impairment that an entity's management must consider at minimum. These include significant decline in market value, any significant adverse changes in the environment or in the market, changes in asset use, such as if the asset becomes idle, and if the economic performance of the asset is worse than expected. While the list is not exhaustive, these various indicators must be considered. In paragraph 130, along with the amount of impairment loss, entities are also required to disclose the events which cause the impairments. An article from PwC states that due to COVID-19, management must exercise significant judgment which reflect the conditions existing at the impairment testing date. Therefore, in compliance with accounting standards, management must provide detailed disclosures and also the rationale adopted in making those judgments. This way, firms cannot simply hide persistent headwinds through one-time impairments. On the other hand, is the option to require entities to depreciate or amortize their assets. The relevant standards are in AASB 116, Plant, Property and Equipment, and AASB 138, Intangible Assets. The standard states that the method used should reflect the asset's future economic benefits to be consumed. This method can be changed if there has been a significant change in the expected pattern of consumption of the asset. For companies operating under COVID-19 circumstances, the entity can select the method that most closely reflects the future economic benefits embodied in the asset. So there is some degree of flexibility to apply whichever method is appropriate, but provided that these are accounted for as a change in accounting estimate or policy as in AASB 108. Due to COVID-19, the requirements have changed due to the ATO providing depreciation tax relief measures for businesses. Since September 2020, tax depreciation write-off rules were expanded and accelerated depreciation for certain eligible asset purchases were introduced. However, due to thresholds in place for these rules, it will mainly benefit only small to medium-sized companies. From a regulatory point of view, impairment is preferred because it takes into account uncertain economic conditions and gives entities that flexibility to impair their assets. If impairment is done as soon as possible and is done correctly, it can also help the entity deal with other consequences such as loans, tax debt covenants, and dividend planning. The standards require extensive disclosure, judgment, and accurate forecasting to decide how much to impair, which is in place to prevent firms from taking big baths. Depreciation or amortization of assets are simply ongoing operations of the company. Despite being able to choose a depreciation method, regulations do not require the methods to reflect economic circumstances. The ATO has also provided some relief measures, but these are limited. Requiring all firms to depreciate and amortize their assets on a prescribed schedule could be harmful to the entity and to other users of the financial statements.
In conclusion, the economic conditions caused by the coronavirus pandemic has led to the big bath phenomenon, which, despite being deemed unethical, has numerous advantages for companies. This was evident through the big baths of Boeing, NAB, and Samsung. In assessing the advantages of managers having the flexibility to change impairments on assets and the advantages of requiring companies to depreciate or amortize assets according to a prescribed schedule, and then taking into account the regulatory perspective, impairment was deemed preferable. This is due to impairment allowing for the consideration of the current economic conditions, as well as being immediate and effective. Therefore, in assessing this phenomenon, big baths were regarded as an intuitive response from companies to hide persistent headwinds.